A very good morning to all of you students. My name is C. Devas Gupta and today we will be continuing our discussion on the topic of derivatives. So students, in our previous session, we started our discussion on options, specifically in derivatives. Now let's take a quick 5 minutes recap before we get into our further part of the today's session. So students, on options, we discussed that first of all, we have taken a specific case of call option in which we said that a call option is a right to buy. Okay, this is the emphasis that we have to give, a right to buy. That means it's a privilege to buy, right? It's not an obligation to buy. What? Buy what? An underlying asset, which can be, in this particular case, we took an example of X limited equity share at a specified price, which means that the strike price or the exercise price is fixed, which can be executed on expiry, which is at an agreed date or up to an agreed date. That means any day up to the expiry date. That was the real difference between an European option and an American option. So similarly, we said that on put options is a right to sell. That is the distinction that we have to always remember. So there is a right to buy, there is a right to sell. Sell what again? The underlying asset at a specified price. Again, here the strike price or the specified price or exercise price is always fixed, right? At which, if you want to exercise your option, you need to sell your underlying asset at that price. At an agreed date means European option, up to an agreed date means American option, students. Okay. So this is what? This is basically a part of derivative, because this entire arrangement of right to buy or right to sell is actually deriving its value from the underlying value of equity share, right? If the underlying value of equity share is higher than the strike price in case of a call option, that means the call option is in the money, right? Where we discussed that. So this was case 1, case 2, case 3. Wait, let me just go to in the money, out of the money. Yeah, this one. Okay. And if the actual share price is lesser than the strike price, then it's not a right anymore, right? Because in the open market itself, we will get the underlying cheaper compared to what we are able to get through this execution. So it is not a right anymore. If it is not a right anymore, that means it is out of the money. That means it will not give you any benefit to the holder. And if it is flat, the price of the equity share, which is the underlying, is as good as the strike price. That means it is at the money. That means it will not fetch you anything. Students, we also discussed about the parties to the option. Now, first of all, in right to buy, there are two different parties. One is holder and another one is writer, or we can also call them as seller. So the holder is also called as buyer. So the buyer of right to sell and seller of right to sell, right to buy. So the buyer of right to buy and the seller of right to buy. So always remember, rights are being traded in case of an option as a part of the financial instrument. Okay. Now on expiry, the option holder of the call option will become buyer of the underlying because they have purchased the right to buy. Similarly, the seller of the right to buy will become seller of the underlying if the option is exercised on expiry. Clear? Now on right to sell, we discuss, students. Right to sell, who is the holder? Who is purchasing the right to sell? So if I am purchasing the right to sell, I am the holder. Similarly, the person who is selling the right to sell becomes the writer. Now the person who is purchasing the right to sell is actually the person who is going to be the seller at the time of execution or at the time of expiry. Correct? Because if I'm having a right to sell on expiry, I will sell the product. That means I will sell the underlying. Similarly here, the other person, the writer of the option, becomes the buyer of the underlying. Okay. And this one chart explained the entire thing. So Mr. A, who is the holder, will give premium to Miss B, who is the writer, right? Why we said premium? Because Mr. A is covered on both the sides. One side he's covered through the option, the second side he's already covered through the underlying, correct? Because Mr. A cannot have any loss. At the same time, Miss B, who is the writer, is undertaking the risk of writing this option. So hence, the writer will expect a premium to undertake that risk. And hence, Mr. A pays premium to Miss B. Similarly, Miss B will sell the right to buy or the right to sell to Mr. A students. Okay. Just imagine, just like there is an insurance company and there is a person who is insured. Okay. Now, this example we took students of the call option where we discussed about both the types of settlements, gross settlement and net settlement. Gross settlement, actual delivery of the share will happen. Gross amount will be paid. Net settlement, only net amount will be paid. Net amount means on expiry, what is the price of underlying, that will be compared to the option price, and that net amount will be released to the option holder by the option writer. Okay. And from that, if we have to calculate the net gain or loss, we'll have to reduce the premium that we have paid respectively to the different, respectively in the different cases, and hence we will arrive at the overall gain or loss. Any question, students, still now, or should we now move ahead? Perfect. So, in this case, we also discussed that loss to the writer will be unlimited, right? Because if the price movements happens very unfavorable way, very high, that means the writer will incur a good amount of loss. Gain to the holder will mean whatever is the loss to the writer will simply become the gain to the holder, which is also unlimited. Similarly, gain to the writer, which is equivalent to the premium amount, will be limited. Similarly, loss to the holder will also be limited. Okay. Okay, then let's move ahead. Okay, now let's take the example of put option, students. Okay, we just took an example of call option towards the end of the previous session. Now let's take an example of put option. So let's assume the strike price to be 110. Spot price is, let's say, 100. Okay, the current price at which the shares are trading is 100. The strike price in case of a put option will mean what? The price at which the underlying can be sold. Correct? That is the strike price. Time to expire is equal to 3 months. And for all simplicity, we are assuming this to be an European option. And we are talking about X Limited equity share. Okay. And similarly, continuing with our previous example, Mr. A is the holder. Miss B is the writer. Now on expiry, let's take now different scenarios, students, right? The spot prices can be different. Let's try to put all of them. Let's take 3, 95, 110, and then 125. So one is we have taken lower, one at the similar level, and one at higher level. Now, students, see, I have a right to sell. I have a right to sell at 110, for which the market price is only 95. Do you think it's a right with me? Come on, students, answer over the chat or whichever way you feel.
Yes.
It's a right for me. Perfect. Why it is right for me? Because I am able to realize 15 rupees more if I sell under this contract. If I sell in the open market, it's not a right anymore. Correct? So, because of this contract, I am having a right. The right's value becomes 15 rupees, which is over and above the market price. And hence, it becomes in the money. The option becomes in the money. So, in this case, right to be exercised. And hence, it becomes in the money. Now, if the strike price is 110 and the actual price is also 110, it becomes at the money. Correct? Because it is indifferent whether we sell in the open market or whether we sell through this option, it's still at the money, right? There is no gain or loss. If the price becomes 125 in the open market, so am I going to sell through this contract at 110? The answer is
No.
no. Perfect. Because I'm going to sell in the open market itself. But in this case, is there a need for me to pay to the option writer the 125 minus 110 rupees difference? Come on, students. Am I obliged to pay this 15 rupees to the option writer? Come on, yes or no?
Premium will be paid.
Sorry?
Premium will be paid.
Premium is already paid, right? So
this
since premium
difference,
is already paid, and we are not talking about forwards. Had it been forward or future, I would have ended up paying this 15 rupees to the option to the counterparty. Since this is an option, this 15 rupees need not be paid. Only the gain needs to be realized. The loss need not be taken by the option holder. So this 125 rupees, there is no loss to him because Mr. A will go in the open market and sell it at 125. Because of the option, there is no loss. Okay, so it's not a right anymore. Okay, out of the money. Okay. Yes, Saminathan, you can say that as well. Okay, he will not exercise the option, although as per the option he has the right. Okay, you can also interpret like that. Now let's come to the holder. So from holder's perspective, call option will be better if the spot price goes up beyond the strike price. So this is finally our conclusion. So this entire discussion on call and put option, just for the sake of understanding and getting it into our minds, we are just saying that for a call option holder, it is better if the spot price goes up slash beyond strike price, correct? And for put option, similarly, a put option holder is better if the spot price goes, come on, students, tell me, it should be up or down?
down.
Down, yes. Down slash below the strike price. Correct? So the holder becomes, so the put option holder is benefited if the prices are lower than the strike price. Now, quickly, students, if we draw a parallel between options and futures, there is an underlying asset. There is an underlying asset here as well. Correct? Is there a time limit? The answer is yes. Both the places there is a time limit. Correct? It's a right. It's a mandate. Mandate means it's an obligation. It's an obligatory thing, right? Even if the movements are positive or negative, it has to happen. Then this right, holder only gain. Correct? Holder will only gain through this process. The strike price is involved in this. Correct? There is a strike price that is involved in this, and there is a premium that needs to be paid. There is a gain slash loss, both, right? Although there is a only gain concept from the holder side in case of an option, there can be a gain slash loss in case of futures. Since there is a strike price over here, there is a future price over here, right? So the strike price is that price at which the execution will happen. The future price becomes the price at which the positive or negative will happen in case of a future. There is a premium involved here. There is no premium involved here. Correct? Because there is no risk to the writer or to the seller, and hence there is no premium involved. Okay, because premium is paid only where there is a disproportionate risk that one party is undertaking. For example, in insurance, for example, in options. Okay. Now, let's also discuss about the payoffs diagram. Okay, payoffs diagram. So we'll take four cases in the students. One for call option, one for put option, one for call option holder. Sorry, one for the holder and one for the seller. So there are total four permutation combinations, right? So let's take an example of strike price 40 and premium is calculated as 5. And we are talking about first case as call option, who is the buyer, holder, having, we can also say that they are having a long position or they are long in the call. Okay. Okay. 0, 10, 20, 30, 40, 50, 60, and this will go on. So this is what we have put here as the price of shares. Okay. Minus 5, 5, 10, 15, and 20. On this axis, we are putting payoffs. Payoffs means the net payoffs, right? There were two ways. One was gross settlement, one was net settlement. So we are discussing here about the net settlement, right? So till the time price is 45. Correct? Strike price is 40 and premium is 5. So till the time price is 45, till the time its price is 45, there will be a loss. Yes, very good, Saminathan, there will be a loss of rupees 5. The moment it increases beyond 45, there will be a profit that will come into the option holder. So the graph will look like this. So this is a loss situation, and then this is the gain situation. Correct? So after the 45 rupees, why we have taken 45? Because 40 rupees is the strike price and 5 rupees is the premium. So beyond 45 rupees, there will be a gain. And that gain now will turn into an unlimited gain, right? But the loss is limited. If you see, if the price is even zero, the loss will only be to the extent of 5 rupees. Clear? That's why we were saying that the loss is the same place at which we are having a limited position. Yes, 45 is the place where there is no loss, no gain, because we have paid 5 rupees premium, and in 45 rupees we will get 5 rupees as the payoff, right, from 40 rupees. Now the next one. Call seller, short sell, or writer of the call. Again, we are assuming strike price to be 40, premium to be rupees 5. Okay. Now we are talking about the person who has sold this call option, or the writer of the call option. Again, let's bring in the same x-axis and y-axis. So here it is 0, 10, 20, 30, 50, 40, 50, 60, 70, and go on. And here it is minus 5, 5, 10, 15, 20, right? So the loss is limited. Sorry, now we're talking about the seller perspective, right? So seller, there is a gain. Gain is limited, right? Till what level? Till 45 rupees the gain will be there. The moment we enter 45, there will be a loss. Correct? As the price increases, there will be a loss beyond 45 rupees, because you're talking from the perspective of call option seller, right? So this becomes 45. This is the price here, and this is the payoffs here. Correct? So here what we can see, students, the gain is limited, but the loss is unlimited. Till 45, gain is limited of rupees 5, then loss will be unlimited. Yes, Saminathan. Perfect. So this is the message that even we are also trying to say. Clear? Any questions till now, students? Okay, perfect. Then the third scenario. Okay, perfect. So the third scenario is on put option. Okay. So the put option now, students, please remember, it is right to sell. In case there is a right to sell, that means the loss or the gain will depend on the reverse price movement. That means if the prices goes down, then there will be a gain. If the prices goes up, then there will be a loss. Okay. So the strike price is again actually 40. The premium is 5. The We are talking about from the perspective of holder, the one who holds, the one who is longing the put, that means who is entering into the long position of the put, and who is the put buyer, right? Just a second. Yeah. Again, the same thing. Here we are talking about price of the share. Here we are putting the payoffs. Again, we start with 0, right? Let's say the price moves up to 10, 20, 30, 40, 50, and 60, and go on. Similarly, here it's minus 5, 5, 10, 15, 20, and 25, like that, right? Now, students, since we are talking about the holder of the put option, the loss will be limited. But till what price? Now, my question comes to you. Till what price the loss is limited to 5 rupees? See, first of all, do all of us agree that since we are paying 5 rupees premium, hence the loss, maximum loss to the option holder can be 5 rupees? Is this statement true, or is this statement understood by all of you students? Till what price the maximum loss will be 5 rupees? Okay, students, come on, tell me. Or let's say at what price there will be no gain, no loss. Okay, let me ask all of you this question. At what price there will be no gain, no loss? If the right to sell is what we're talking about, which is put option, the strike price is 40 and premium is 5. Come on, students, tell me.
40 and above.
Sorry?
40 and above.
Sorry, your voice is not coming out correct. What are you saying? So my question to all of you is, at what price there will be no gain, no loss? Very good, Chitra. Chitra has reverted and the answer is correct, Chitra. Anyone else? Yes, Saminathan. Very good. Perfect. So the right answer is BO is saying 40 and above, or 40 and below. We should say 35, right? Because here we are talking about put option. That is where I was trying to make a distinction, that this is not a call option, this is a put option. And put option, as the prices goes down, you will be benefited, right? So the 5 rupees gain, sorry, there will be a loss, right, to the holder. So the 5 rupees loss will continue and will turn into profit as the prices goes below 40 and 35, right? So here it is 35, students. Correct? So at 35 rupees, there will be no gain, no loss, because at 35, what will be the net payout? 40 minus 35, which is 5 rupees. And there is a 5 rupees of premium that Mr. A has already paid. So that means there is no gain, no loss at 35. But as the prices come below 35, there will be a further gain to Mr. A. Yes, Aminathan, you're right. Then the last part, the last situation rather, is for the put option seller. Put option seller, short put, also called as writer of put option, strike price 40, premium 5 rupees. Again the same thing, 10, 20, 30, 40, 50, 60, go on. This is on price 0, minus 5, 5, 10, 15, 20, 25. Okay. The gain will be limited till the time the pricing is 35, then it goes down and turns into a loss. Correct? There is a 5 rupees gain here. 35 is the price at which the neutrality will come for the option writer as well as the option holder. Below 35, if the prices comes, then it becomes a loss to the option, put option buyer, or put option seller students. Okay. I hope this is clear, students. The payoffs, all the 4 different scenarios. This is critical from the understanding of what happens in the overall options, right? And again, I'm saying that let's not confuse the option buyer, option seller with the underlying buyer and underlying seller, because the put option buyer can be in the similar situation of that the seller of the underlying, correct? So never confuse both of them. Okay. Now, students, we discussed about equity, right? So what happens in spot market for equity? Let's say this is a stock exchange. This is the price at which the equity is quoted on a stock exchange. There is a buyer who will place the request to buy the equity shares on the stock exchange. Similarly, there will be a seller who will place a request to sell on stock exchange. So that means overall what is happening here, students? Overall here, the buyer and seller are being contacted through or connected through stock exchange. The price matches for both of them request, the deal happens. Let's say the buyer is quoting 100, but the seller is quoting 120. There is another buyer who's quoting 110. There is another seller who's quoting 110. So at this price, the price matches and the deal will happen. And the pricing in stock exchange becomes 110. So it is just pure play market forces that derives the prices, right, for equity. But the price is the element which is listed on the exchange, and at that price, plus or minus, the buyer and seller will place their bids and asks. Similarly, students, what happens in case of a futures? So futures, what do you think will be dealt with on the stock exchange with the buyer and seller? So there is a buyer of the futures, there is a seller of the futures. We discussed, right? Futures are traded on a stock exchange. Forwards are not, because forwards are customized. They're over the counter. But futures are standardized contracts. Sorry. So the futures are standardized contracts. Come on, students. Just if you want to attempt this answer, so my question is that for equity, the price is quoted on the stock exchange for the purpose of sale or purchase. But what happens for futures, students? For futures, what is quoted on a stock exchange at which the dealing happens?
Future price, sir.
Very good. No, Chitra, not strike price. Strike price is for options, right? So futures will be futures price. And students, all of you remember that we have already discussed how to calculate the future prices, right? Through present value and future value formula. Future prices will be equal to the present value multiplied by the respective compounding rate. Using that, we will calculate the future prices. Clear? So this is for futures. This is happening on stock exchange. This is also happening on stock exchange. Okay? And let's talk about options. Okay? For options, again there is a buyer or holder of the option. There is a seller or writer of the option. So buyer will place the request to buy the right. Seller will place the request to sell the right. Now the right can be of right to buy or right to sell. That's a separate story, right? Now on stock exchange, come on students, tell me what would be dealt with here? Yes, Saminathan, your answer is correct. Anyone else would want to attempt? At what, or let's say what is the metric at which the buyer and holder will be there on this stock exchange? The correct answer is premium. Because premium is the pricing of that option, right? Premium is the pricing of that option. And it is derived using what? It is derived using the formulas that we will see. Okay. But premium plays a very big role in terms of the justification of the buyer or seller positions for the options. If we purchase call option at the rate of 20 rupees premium, right? This is one of the statement. So what price are you buying the call option at? At 20 rupees premium. But students, please do remember, whatever premium is being quoted on the stock exchange at which the transactions are happening, that will be specifying whether it is a call option or a put option, whether it is what is the strike price of that call option or a put option, what is the underlying, what is the expiry, everything will be specified for that particular contract for which the premium is quoted on the stock exchange. So that will be written while you will go through the dealings. Okay. Okay. Similarly, if you want to purchase put option at the rate 25 rupees premium is, let's say, the pricing is there. So that means the price of that put option becomes 25 rupees, correct? And at which you are purchasing the right to sell, students. Okay. Now let's come to the next part, which is the valuation techniques, right? So in case of a forward or future, we discussed about the valuation techniques, right? The theoretical minimum price, right? The present value, future value concept. Clear? Yes, premium is playing the major role on options. Correct. Because premium is the price at which you purchase or sell the options. Now, valuation technique, students. So the first valuation technique we are talking about is binomial model. So as the name suggests, bi means two, upper and lower, one, two. So bi means either this or that, right? We say that binary digits, right? By there is bi-monthly meeting, right? So either it can be only two options are there, one and second. So one we assume the upper higher price, and second we assume the lower price. So there are only two possibilities. One, there will be a higher price of this much, there will be a lower price of this much. Okay. Then there is a call option. Let's say the rate of interest is 10% per annum. Correct? Because while valuing, we need to understand that what is the rate of interest, similar to the forward slash futures. Strike price is, let's say, 28 rupees. Okay. Now, let's assume that today's price, this is 0th day, is 30 rupees. Okay. Let's say today's price is 30 rupees on the date at which we are standing today. 3 months from now, let's take a time period expiry of 3 months. So what this approach assumes that there are only two possibilities. After 3 months, either the price will go up by 10% or it will go down by 10%. So 30 plus 10% of 30, which is 33. 30 minus 10% of 30, 27. Correct? So either it will be higher by 33, either it will be lower by 27. $33. Now, let me just introduce one more thing here. Now, can we also calculate what will be the payoffs on these different nodes? So these are called as nodes, right? The different values on these are, these specific pointers are called as nodes. Now, at 33 rupees after 3 months, what will be the payout? And at 27 rupees after 3 months, what will be the payout? What was the strike price, students? Strike price was 28. What is the nature of this option? Call or put? The option is call option. So 33 rupees minus 28 is what? Becomes 5 rupees. Correct?
Gain.
Gain. Similarly, here 27 is the actual price. 28 was the strike price. Will there be a gain? Will there be a loss? Or will there be zero? It will be zero. Correct? Because there will be no loss to the option holder. Now, one more thing we'll have to understand here, that since the method says either the price will be higher or lower, there will be a probability attached to the prices being higher or lower. So let's understand this first. There are two ways to calculate probability. Both of them are derived. Both of them, the second one is derived from the first one. So whichever way you use, it's fine. So the first one is probability of prices going up, P bracket U is equal to 1 plus R, which is the rate of interest, minus D divided by U minus D, or e raised to the power RT minus D divided by U minus D. So R here is equal to rate of interest. D here is equal to proportion of reduced price, which is 27 by 30. 27 was the new price, 30 was the original price, right? So 10% it came down. So that means D is equal to 0.90. 0.90. U is equal to proportion of increased prices, which is 33 by 30, right? So which effectively becomes 1.10. Now, if it is a simple compounding or a simple method, this becomes the formula. If there is a continuous compounding, right? Sometimes the question might tell you that there is a continuous compounding, e raised to the power RT minus D divided by U minus D, students. Correct? So here, if R is per annum of 10%, so R for 3 months becomes what? 10% divided by 12 into 3. Very good, Sambhinathan. It's 2.5% quarterly. The interest becomes quarterly 2.5%. Here, if we come back, so the probability of prices going up becomes 1 plus 2.5% minus 27 divided by 30 divided by 33 divided by 30 minus 27 divided by 30. Is equal to 62.50%. So the probability that the prices will become 33 is 62.5% probability. Now students, all of you tell me, if the probability that the prices goes up is 62.50%, what is the probability that the prices will go down? Come on students, I think this we have not
37.5.
discussed till now. Yes. Sorry?
47.5.
Very good. Yes. So
100 minus 62.5.
very good. So 37.50% becomes the probability that the prices will go down. Clear, students? So the formula is very clear. So the probability that the prices will go up is 62.5%, which is effectively if the prices move to 33, there is 62.5% chances. If the prices becomes 27, there is only 37.50% chances. So here 5 multiplied by 62.50 percentage. Here it will be 37.50 percentage. So this 5 into 62.5 becomes 3.125, and here it becomes 0. So the price of the option after 3 months becomes 3.125. So the future value, so the third month value of this call option is 3.125. So we will just add both of them, although it is 0. So the total becomes 3.125, students. Clear, students? This is the this is the binomial method. So what has happened? Okay, let me just quickly recap. In binomial method, first of all, there is an inherent assumption that only two possibilities are there. Either the price is going up or the price is going down. If the prices goes up, there is a probability assigned to it. The probability is actually calculated through this formula 1 plus r minus d divided by u minus d, where d and u represents the proportion of prices going down and prices going up respectively. And then we arrive at the probability, take the weighted average payouts multiplied through their probabilities and take a summation that becomes the overall option premium. Right? Now, students, here we said that there are two ways to calculate the probability. So the first one we discussed. Now let's discuss about the second one, which is called as the risk neutral method. Right? So the risk neutral method. Now here, let's assume the probability to be P for the prices going up. Let the probability of price being 33BP. Accordingly, the probability of price being 27 will be accordingly the probability of price being 27 will be 1 minus P. Correct? Because both of them has to equal to 1. That's the fundamental principle of a probability, where all possibilities, if we assign probabilities to them, the summation of them will become 1, should become 1. Now this, if this keeping in mind, the risk neutral method says that your weighted average price after 3 months will be equal to the today's price if you take a present value of it. So which is given by this equation, 30 rupees is equal to, which is the today's spot price, 33 multiplied by its probability plus 27 multiplied by its probability whole divided by 1 plus r percent. Clear? So there is a actual price, and this equation represents what? The right hand side part of the equation represents the present value of the expected price. Correct? We are dividing by 1 plus r, which is making this value as a present value, and these are the weighted averages, right, of the prices. So 33 into p plus 27 into 1 minus p. So their respective probabilities are being multiplied into them. There is a weighted average that we are calculating. Now if we solve for p here, so 30 is equal to 33p plus 27 minus 27p divided by 1 plus, what is r here? 2.5 percentage, right? So r will have to take only for 3 months, because here the instrument was devised for 3 months, students. So this becomes 30.75 minus 27 is equal to 6p. P is equal to 3.75 divided by 6 is equal to 62.50 percentage, which is the price going up. Correct? The similar result what was there in the previous method as well, right? 62.5 was the price is going up, the probability, and here 1 minus p is actually 1 minus 62.50 percentage, which is actually 37.50, the probability of prices going down. Clear, students? I hope the binomial method is now clear. And ultimately, as per binomial method, now the last step which is left in binomial method is the value of the option, the valuation of the option, right? Because till now, we have calculated the different probabilities, we have calculated the weighted average premium on maturity. Now we'll have to calculate the value of the option as on today. So the value of option is equal to present value of probability adjusted payoffs. As per binomial method, whatever are the payoffs, those you need to adjust as per the present value of the probabilities. Okay. So here the value of call option became is equal to 3.125 divided by 1 plus r%. Correct? Because 3.125 was the value of the option on 3 months, on third month, right? Here 1 plus r again will be 1 plus 2.5 percentage. Correct? So this will become 3.0487. So the value of call option is equal to 3.0487. Correct? This is the present value of 3.125. Clear? Let's move ahead, students. So options till now, students, what we have covered: options. We have covered the basics. We have covered the parties to the options. We have covered call option, put option. What is the difference? We have covered what is the difference between an option and a forward or a future. We have discussed how to calculate the premium using one of the method called as the binomial method. Correct? It's very simple, very easy. We have to calculate the probabilities for the prices going up and down and take the weighted average using the probabilities at the payoffs at the maturity, take the present value to it. That becomes the value of the option. Whether it is a call option, whether it is a put option, the approach remains similar. Okay. Now let's attempt the question number 1 from the second assignment that was there on the portal. Okay. So yeah, students. Equity share of PQR Limited is presently quoted at rupees 320. The market price of the share after 6 months has the following probability distribution. The market price of 180 rupees, there is a 0.1, that means there is a 10% chance the price will be 180. There is a 20% chance that the price will be 260. There is a 50% chance that the price will be 280, which is a majority one, right? So 50% chances that the price will be 280. 10% chance price will be 320 and another 10% chance that price will be 400. A put option with a strike price of rupees 300 can be written. Can be written means it can be sold. So the put option with a strike price of 300. You're required to find out the expected value of option at maturity, students. At maturity. Correct? So they are not saying you calculate it as on today. So just see the different variations in the questions, how they will change the respective solutions. Okay. So what is the strike price? 300. Right? Let's say this is 350. Let's say this is 250. 200. 150. This is at the money, right? So this is out of the money. This is in the money, right? Because we're talking about put option here. And the put option becomes out of the money when the spot price moves above the strike price, which is 300, right? Clear? Now, can anyone tell me what should we do in this case? First of all, should we calculate the payoffs in different market prices, or should we calculate the single market price at a weighted average and then calculate the payoff? Come on, students. I'm just trying to understand. Okay, single market price at weighted. Saminathan is saying that. Any other thought? Should we not calculate the different payoffs at different prices and then those payoffs can be multiplied with the weights as probability? Okay, let's see. Since in the above situation as well, what we have done here, students, we have first calculated the payoffs and then multiplied with the probability, because we cannot say that if the prices, where's the question? Yeah, here. If the prices are 400, 300 being the put option strike price, the benefit will be there. The benefit will be 0. So let's build that 0 into our solution. Okay. So the expected value of an option at maturity, this is, let's say, probability. These are the different market prices. This is a put option. This is the probability multiplied by option value. So the probability is 0.10, 0.20, 0.50, 0.10, and again 0.10, right? What are the different market prices? 180, 260, 280, 320, 400. If the put option is 300, that means what? If the market price is 180, put option strike price is 300. In the first part, there will be a gain of 120 rupees, students, right?
Yes.
Here, there will be a gain of 40 rupees, which is 300 minus 260. And at the rate of 280, the strike price is 300. There will be a 20 rupees
20
gain
rupees.
here. Perfect. And here it will be 0 and 0. Now here in the next part, we will multiply the probability into the option payoffs. Correct? So this is 12, 0.20 into 40, which is 8, 0.50 into 20, which is equal to 10, dash and then dash, right? So the value becomes 30 here. Expected value of put on expiry is equal to rupees 30. The answer is simple and easy. This is what they have asked us, right? What is the expected value of the option on expiry? So we have just calculated it simply using the bases. Clear, students?
Clear.
Perfect. Let's go to question number 2. Yeah. You, as an investor, had purchased a 4-month call option on the equity shares of X Limited of rupees 10, of which the current market price is 132 and the exercise price is 150, students. Exercise price is 150, current spot price is 132, 4-month call option rupee 10 is the premium. You expect the price to range between rupees 120 to 190. The expected share price of X Limited and the related probability is given below. The expected price is 120, 140, 160, 180 and 190. There are different probabilities that are also given. 5%, 20%, 50%, 10% and 15%. Compute the following. Expected share price at the end of the 4 months. Value of call option at the end of the 4 months if the exercise price prevails. In case the option is held to maturity, what will be the expected value of the call option? Okay. So let's talk about the solution here, students. Calculation of expected share price. Price probability. Now here the question is straightforwardly asking us that what is the expected share price? The expected share price will be the probability multiplied by the respective prices. 120. The probability is 0.05. It is going to be 6. 140. 0.20. It's going to be 28. 160. 0.50. It's going to be 80. 180. 0.10. It's going to be 18. 190. 0.15. 28.50. 160.50. So this is the price multiplied by the respective probabilities to arrive at the overall expected share price. Value of call option at the end of 4 months if the exercise price prevails. Simple. So they are saying that what is the value of call option after 4 months if the exercise price itself prevails. Value of call option is equal to spot price minus strike price. 150 minus 150 is equal to 0. So that means the similar price, what was the strike price? 150, right? So the question is trying to say if 150 is the actual price, then what becomes the value of call option? It is at the money. The third part. In case the option is held to maturity, what will be the expected value of the call option? Now, students, we have already calculated.
I have a question. Why did we take this Strike price is 150 in second part.
Yeah, because in the second part, it says that if the exercise price prevails. So that means it is trying to say that what if your actual price itself becomes your exercise price?
Right. Right.
Correct?
Right. Got it.
So,
Yes.
yeah, so because of this line, this specific line, if the exercise price prevails. Okay. Now, in the third part, I'm trying to do something. Let me know whether that is correct or not. Okay. The third part says, in case the option is held to maturity, what will be the expected value of the call option? What I will do, I will just simply take this value because this is what we've already calculated and compare it with 150. Expected value of call option on maturity, students. I will just simply take this minus 150. What is the value, students? 10.50. Any questions?
I think we should calculate this first. The exercise price. What would be the price value of the option individually? Then we will take the total.
Correct. That was I was expecting. So this is a wrong answer. Everyone, please understand. I'm just trying to tell you a very big difference. So in this, again, as I said in the first question, we are making an inherent assumption that even the prices at 120 we are gaining. At prices 140 we are gaining, but it's not the case because the strike price is 150. So hence taking this assumption is wrong. Let's write it as well. Why it is wrong? In the above case, we are making an assumption that there is a loss when expected price is lower than strike price. Please note this in very bold letters that if you just simply do this, then you are making this assumption that if the prices is 120 or 140, you're assuming that there is a equivalent loss that is being made on those amounts. So then what is the correct solution, students? So the correct solution becomes expected value of call option on maturity. So there is a price, there is a value of call option, there is a probability, and then probability multiplied by value of call option. 120, value of call option will be 0 because at 120 the strike price is 150, there is no value here, so probability becomes 5%, but still it will be 0, right? The second price was 140, still the value of call option will be 0. At 20%, the probability into value of call option becomes 0. 160, the value of call option becomes 10. The probability is 50%. 50% on 10 becomes 5 rupees. This is what the value of call option is. 180, at this, the value of call option is 30.
30.
10% is equal to 3. rupees. 10% into 30 is equal to 3 rupees. 190, 40, 15%. So 15% of 40 becomes 6. So this is the value of call option, expected value of the call option on maturity. Just simply multiply it with the respective weight. So this becomes 14 and this overall becomes 1. Okay, students, so this is understood. So let's not make this mistake. Let's do this in the proper way. That was the main highlight I was trying to emphasize on. Yes, very good. Saminathan, your answers are correct. Perfect. Now let's move to another concept within options itself. Now please understand this is going to be further level up now. Okay, so students, if I ask you what is the broad principle of premium, while we calculate premium or what is the right value to be assigned to premium will be spot price minus strike price. I'm not getting into call or put because whether it is call, whether it is put, still you will be comparing your spot price with the strike price. And this is adjusted for certain things. So let's say today strike price is equal to 100, spot price is equal to 120, there is a premium of 20 rupees. Let's talk about call option, right? But there is a difference of 20 rupees since we are talking about today and this option is for let's say 6 months. Okay, so what will happen, students? It will not show as 20 rupees as is the premium. It will show as 18 rupees maybe, just to adjust for the present value, right? The present value might move this 20 rupees to 18 rupees. Okay, now let's say after 3 months, so the overall period was 6 months for this, but let's assume after 3 months the strike price is actually 100, spot price is 180, 80 becomes the premium, which then comes to 77 as the premium, right? Entire 80 rupees will not be the premium because still there is 3 months to go. So don't you think it is getting adjusted for certain things, right? Which is let's say the time value of money, which will be even some of the risk propositions that we are going to take. Okay. Now, first of all, let's do this question number 3, students. A very, very good question. Yes. A call option on gold with exercise price of 26,000 per 10 gram and 3 months to expire is being traded at a premium of 1010 per 10 gram. It is expected that in 3 months' time, the spot price might change to rupees 27,300 or 24,700 per 10 grams. So there are two possibilities. One, the price is going up to 27,300, or the second, the price is going down to 24,700. At present, this option is at the money and the rate of interest with simple compounding is 12% per annum. Is the current premium for the option justified? Evaluate the option. What is the current premium? 1010. Okay. If it is justified, then you will have to evaluate. Now, student, there are multiple things that are given. Now, first of all, tell me, using the approach of binomial model, can we assess first of all that what should be the right premium? Because we have been given only two possibilities on expiry. One is higher or lower. So here the prices are moving as 27,300. Here the prices are moving as 24,700. So let's do the calculation of probabilities. Let's assume probability of price going up be PU. The probability of price going up will become 1 plus R% minus D divided by U minus D. 1 plus 12% into 3 by 12 minus D will be what? The proportionate prices going down. So 26,000. 24,700 divided by 26,000, because 26,000 is the current price. Whole divided by 27,300 divided by 26,000 again minus 24,700 divided by 26,000. So the probability of prices going up 0.80, probability of prices going down will become 0.20, right? If we solve this equation, this entirely is 1. Okay, if we solve this, the probability of prices going up becomes 80%. Hence, the value of option can be calculated as, let's talk about the event first. Event is price is going up, price is going down. Strike price. So what was said for strike price? At present, this option is at the money. That means the strike price is equal to the spot price at the money means no gain, no loss, right? So that can only happen if it is at the strike price itself. 26,000. 26,000. Then we will also put down what is our expected price. 27,300. 24,700. Payoffs. Here it comes out to be 1,300. Here it is null. Probability into payoffs. 80% into 1,300. 1040. 20% into 0 is equal to 0. 1040. Correct? So this is the expected value after. Yeah, very good. Saminathan, very good. Okay, so 1040 becomes the expected value. Now let's be very clear. This becomes the expected value of options at the expiry of 3 months. 1040. Value of call option. 1040 divided by 1 plus 12% into 12 into 3 divided by 12, right? Which is for 3 months. 1040 divided by 1.03. Hence, the overall value of call option. No, please check once, Saminathan. The answer should be 1040 divided by 1.03 should be 1009.71, or in the round off, can we say 1010? Okay. Now, what was question asking us? That it is currently trading at a premium of 1010. So, is the current premium of the option justified? Tell me, students. Quoted premium 1010. Calculated premium using binomial method 1010. Is it justified? The answer is yes, it is justified. Both the places we are getting the same, right? So thus the price of the option is justified, students. Any questions, students, till now in the binomial method that we discussed for the options valuation? The overall concepts of options. Let me check the query handle as well in case there is something. No. Okay, perfect. So if concept, okay. Thank you, Saminathan. Thanks for that. Okay then. So let's students, let's break for 10 minutes. Let's again reconvene at 8:45 students. Okay. Let's go to the next question. Question number 4. Okay, so question number 4 says a call and put exist on the same stock of which each is exercisable at rupees 60. Okay, so the exercise price is 60 for both call and put. The market price of stock or stock index is rupees 55. That's the current market price. The market price of call is 9 rupees. The market price of put is 1 rupees. Calculate the expiration date, cash flow, investment value, and net profit. They're asking us to calculate three things, right? What is the cash flow? What is the net profit? And what is the investment value? From buy one call, write one put, buy one put, write one put. So all four scenarios they have asked. For expiration date, stock prices are 50, 55, 60, 65, and 70. They have given us the different prices as well. So let's calculate first of all the cash flows, the expiration date cash flows. The strike price is 50, 55, 60, 65, 70. Buy one call. Call, what is the strike price? 60, right? For both call and put, the strike price is 60. So anything less than 60 will be a no gain, no loss, right? Because you're talking about buy one call, right? So nil, nil, nil here as well. The moment it crosses 60, right? So it becomes 65. The cash outflow will be there, right? Minus 60, which is the equivalent value of the strike price. And here also minus 60. These are the overall cash flows, right? At a gross level. Right? One call. So if we are writing one call, that means we are selling the right to buy. If we are selling the right to buy, that means we have to buy the stock today, right? Which is nil, nil, nil here. If we buy the stock today, the cash inflow will be there of 60 rupees. Clear? Then buy one put. So if we have bought one put, that means we have bought the right to sell. We have purchased the right to sell. The moment we have purchased the right to sell, if we are going to sell, we are going to get a cash flow in of rupees 60, which is the strike price. But what are the conditions in which we are going to sell it? If the prices are lower than 60, right? Which is in these cases plus 60, plus 60, nil, nil, and nil. What if we are writing one put? If we are writing one put, that means we are selling the right to sell. If someone exercises that right to sell, they are going to sell the stock to us. The moment they are going to sell the stock to us, that means we have to purchase the stock. If we have to purchase the stock, there will be a cash outflow. Now, in which situations we are going to purchase the stock? Whenever the prices is lower than 60 rupees, because we are talking about the put option. Nil, nil, and nil. So expiration date cash flows are clear. Okay. So now the next part is actually the expiration date investment value. expiration date, investment value 50, 55, 60, 65, and then 70. Buy one, call option. If you're buying one call option, so first of all, students, investment value will be as good as your premium, right? So if 60 rupees is the strike price, we are talking about call option. So there is no investment till here. Here only 5 rupees and here only 10 rupees. Write one call option. Nil nil, and here it will be minus 5 and here it will be minus 10 students. There is a loss to the writer of the call option. If we are buying one put, lower prices will mean higher value of the investment, right? The value will go higher. So that means plus 10, plus 5, nil, nil, and nil. Correct? Because of the put option. Right? One put option, minus 10, minus 5, nil, nil, and nil. Okay, students. I hope this is clear till now.
Clear.
Perfect. Now, the third part, on the expiration date, they're asking us the net profits. How do you calculate the net profits, which is as good as net payoffs? Right? Payoff at the end minus premium. Fifty, 55, 60, 65, 70. Buy one call option. So what was the premium that was paid? So if you see
9 rupees.
students, yes, 9 rupees. So this becomes actually your payoff table as well, right? Payoffs at the end, correct? And call option, the premium was 9 rupees that we have paid. So 9 minus 9 plus 0, right? Because we have received 0. So it becomes minus 9. 55 also minus 9. Here also minus 9. Now here at 65 rupees, we would have got 5 rupees, right? Because of the higher spot price compared to the strike price. The moment it is higher, yes. So the minus 9 of premium results into a overall loss of only 4 rupees. Correct? Minus 9 plus 5. And here minus 9 plus 10, which is plus 1. Correct? So this is the net profit on expiration date. Write one call option. Here there will be an income of 9 rupees. Here there will be an income of 9. Here there will also be an income of 4 rupees. And here there will be a net loss of 1 rupee. See, the very opposite position will be holding true for the writer of the call option, right? Whatever situation is for the buyer, the very opposite condition will hold true even for the writer of the call option. Clear? buy one put option. So in case we are buying a put option, we will pay a premium of 1 rupee. The put option premium is 1 rupee, this one. And we have got a benefit of 10 rupees here. So 10 minus 1, 9. Similarly, we have got a benefit of 5 rupees here. 5 minus 1, 4. Plus 4 plus 9. Then at 60 rupees, there will be no gain, but there will be a payment of premium that we have done, so which becomes minus 1. Here also minus 1 and minus 1, because even at a pricing of 65 and 70, there will not be any premium that will, there will not be any payoffs that will be received by the option buyer, because we're talking about put option at the strike price of 60 rupees. Then there is one more, write one put. So writing one put at 50, the stock price is 50, strike price is 60. So 10 rupees needs to be paid as a payoff, and 1 rupee is already realized as premium, so minus 9. Here 5 rupees paid as a payoff, 1 rupees realized as a premium, so minus 4. Similarly here plus 1 plus 1 plus 1 for the 1 rupee of premium that they have realized basically. Okay, students. So this is how the net profit or the net loss on maturity can be calculated. It's just a simple comparison between the payoffs and the premium that we are paying, students. Next question, students. Question number 5. Ram, holding shares of Reliance Industries Limited, which is currently selling at rupees 1000. He is expecting that this price will further fall due to lower than expected level of profits to be announced after 1 month. As on the following option, contract are available in Reliance shares. There are different strike prices. The call option is there, the put option is there, and he's already holding the shares. There is a risk of downside. Ram is interested in selling his stock holding as he cannot afford to lose more than 5% of its value. Recommend a hedging strategy with option and show how his position will be protected. So they have given you the risk. What's the risk? The risk is only to the extent of 5% of its overall value. What is the share price? 1000. So come on, students, tell me, if I am holding the shares in spot market, if I'm holding the shares in spot market, which is the underlying market, which risk am I exposed to? The risk of prices going up, option A, or option B, risk of prices going down. Come on, students, tell me.
Risk of prices going down.
Yes, very
Going
good.
down.
Going down, yes. So this is the risk I'm exposed to. Now, if this is the risk I'm exposed to, can you tell me the strategy I should have to avoid the risk? So I have to devise a strategy. If the prices goes down, I should gain. In that case, should I purchase call option? or should I purchase put option? Come on, students. Yes, we'll have to take opposite position, but which thing has to be decided here, right? Which option has to be decided here? Whether we have to take a call option or whether we have to take a put option. Come on, students. First or this one is second. First or second, which one is it? Tell me, students. If I have to devise a strategy in which I will have to gain in case the prices goes down, which option should I take? Call or put?
I think any of options can be taken. It depends
Put
on.
option.
No, we'll have to take one, right? Yes, Chitra, you're right. Saminathan, you're right. So why we cannot take both or why we cannot take call? See, we have to cover ourselves from the risk of prices going down. Now, if the prices will go down, we will gain only in case of a put option if we are a holder of the put option, right? So this is the right answer. This is not. So now we have been given different call and put options. So these call options we can ignore. Only put options we can focus. Solution. Instead of selling the stock of Reliance Limited, Ram must lower his risk by buying a put option. Since Ram's risk appetite is 5%, the most suitable strike price is put option. Most suitable strike price in put option will be 950 rupees, right? Which is 1000 minus 5% of 1000. So this 950 strike price is currently being traded at 8 rupees of premium. Hence, Ram would buy a put option with a strike price of rupees 950. Correct? This is the price at which the put option should be purchased. So as to devise a proper hedging strategy, students. Yes, Saminathan, you are correct. Clear, students? I think here there was a bit of confusion whether we should take a call option or whether we should take a put option. I hope that is now clear. In which situations we'll have to take a call option. So let's say if we have to cover the risk of prices going up, then we will take a call option, right? Just like we used to do in forwards and futures, right? Next question, students. Question number 6. The market received rumor about ABC Corporation's tie-up with a multinational company. This has induced the market price to move up. If the rumor is false, the ABC Corporation stock price will probably fall dramatically. So if you see, the question is indicating towards two possibilities: either the prices will go up or the prices will go down. To protect from this, an investor has bought the call and put options. Okay, the investor has bought the call and put options. He purchased one 3 months call with a striking price of rupees 42 for rupees 2 premium, and paid rupee 1 per share premium for a 3 months put with a striking price of 40. Yes, it's a binomial model. So 3 months call. Let's see the requirement of the question. 3 months call with strike price of 42 at the rate of 2, and 3 months put with strike price of 40 at the rate of rupees 1. Determine the investor's position if the tie-up offer bids the price of ABC Corporation stock up to 43 rupees in 3 months' time. So they are saying the rumor was not false, the rumor has happened, there is a tie-up because of which the prices have moved up to rupees 43. Now determine the investor's position. So for determining that, let's simply put the cash inflows and cash outflows, right? So first of all, the cost of call and put options is premium of call option, premium of put option. It was paid as rupees 2, it was paid as rupee 1. Let's put the strike price over here, 42 and 40. In totality rupees 3. Clear? So this is the net premium, students. Now the first part. So this is a total premium of 3 rupees. We have taken two positions, one in the call option at 42, one is the put option at 40. Right? So the price increases. To rupees 43 per share. So the call option is actually 43 minus 42, right? Effectively, this is rupee 1. Put option nil. Why? Because the strike price is already lower, 40 rupees. If the actual price is higher than 42 rupees, there will be no gain, no loss. So the total inflow at 43 will be 1 minus premium paid is 3 rupees. So the net loss is actually 2 rupees. Is actually 2 rupees. Okay, students. So this is what it is. If the prices increases to 43 per share. The second part. Determine the investor's ending position if the tie-up program fails and the price of the stock falls to 36 in 3 months. So now they are saying it has fallen down to 36. Sorry. So the ending position will now become basis 36. Now the put option will be exercised, right? Because put option was 40. So it will be exercised as 36. Which means effectively 4 rupee. Call option, nothing will be exercised. It will be 0 minus call and put options premium needs to be deposited as minus 3. So net plus 1 will be the net gain, students. Clear, students? Although this question initially was indicating on binomial model, but since the question later on asks certain things which for which we never need to calculate the premium, so hence it is taken basis the solution. Okay, now the next part, question number 7 now, students. Okay, Mr. X established the following strategy on Delta Corporation's stock. Purchased 3-month call option with a premium of 30 and an exercise price of 550. Purchased one 3-month put option with a premium of rupees 5 and an exercise price of rupees 450. Delta Corporation's stock is currently selling at rupees 500. Determine profit or loss if the price of Delta Corporations remains 500 after 3 months, falls to 350 after 3 months, and raises to 600. Assume the size options is 100 shares of Delta Corporation. This is the lot size. So they have given us a call and a put option with the respective premiums, and they've asked us to calculate the implications, right? So the premium exercise price, lot size, and total premium. Let's first calculate what is the overall total premium that we have paid. 3 months call option, students. Premium is how much? 30. Exercise price of 550. Lot size is 100. So 3000 premium we would have paid on the overall contract value. 3 months put option 5 is the premium, 450 is the exercise price, 100 is the lot size, so 500 becomes the total premium of 3 months put. 3500 becomes the initial payment of premium is 3500, students. Clear? So this is the initial premium that we have paid. Now I want all of you to answer if, okay, let's go step by step. If the prices goes these much, then I would want all of you to answer what would be the call and put option payoffs will be. Okay. Now let's put at maturity. Let's first take the price of 500. Now tell me, students, we will talk about, let's say, call option here. What is the strike price of the call option? 550. Actual price is 500. Now students, tell me whether it is in the money, out of the money, or at the money. Compared to this 500, whether it is in the money, out of the money, will be
In the money.
exercised or not?
In the
Sorry?
money. In the money.
No, please check again. The option strike price is 550. Maturity price, spot price is only 500. It is lower. So if it is lower, call option is out of the money, right? If it is out of the money, it will not be exercised.
This will not be exercised.
Perfect.
That is out of yes.
Aha, right. Now put option at the strike price of 450. The spot price is 500. Now students, again tell me whether it is out of the money or whether it is in the money. Please think carefully and then answer. The spot price is higher than the strike price of a put option. Is it a indication of in the money, out of the money, or what? Very good, Saminathan. Your answer is correct. You
Will
reverted.
not sell.
Will not sell. Yes, perfect. So this is out of the money.
Out of money.
And hence not exercised. Okay. So the net loss here will be equivalent to the premium that we have paid as 35. As 3500, that will be the net loss. The second pricing was how much? 350. ₹350. Now let's talk about call option first. Strike price
Out of
550.
money.
Out of the money, very good, because the spot price is lower and hence it will not be exercised. Then put option. Put option is at 450 strike price. Now students, put option strike price is higher, spot price is lower. Is it in the money or out of the money? Actual price has become
Out of
lower
money.
than the strike price. Sorry, it will be in the money, right? Because this contract we will use now to execute, because outside market I am only able to sell at 350. Under this contract I will be able to sell it at 450.
Yes.
So there is a 50 rupees gain. Sorry, there is a 100 rupees gain, correct? So that is why it will become in the money. So 100 into 100, 10,000 will be the gain. So the overall receipts or let's simply say cash inflow, minus premium paid 3500 and hence become 6500 as net gain. Correct? So this is the second part where the at maturity value becomes 350. Now simply the third part where at maturity value becomes 600 students. Let's talk about call option. Strike price 550. Now students tell me call option is in the money or out of the money?
In the money, sir.
It is in the money. Very good. So Nathan, please check. This is in the money. Because the actual price is higher. The spot price is higher than the strike price. $600 minus 550 into 100. 5,000. 550 is the strike price, Aminathan. Yes. 550 is the strike price. So put option. The strike price is 450. Actual price is higher than the strike price for this put option. Suggest students, this will be out of the money or in the money? Come on, students. This
In
will
the
be
money.
no. The actual price is 600. Strike price is
Out
450. This will be out of the money, right? Because you will not exercise this option now. You will just go in the open market and sell it at 600. So this option will not give you anything, right? You will
Yes,
do
right.
just
Yes.
operations. Yeah.
Right.
Out of the money. So I would suggest that all of you please do revise what we are studying in the session so that it fits the logic. Always remember the logic for call option and put option. Call option will be in the money only when your execution through the contract is beneficial. Similarly, put option will be in the money only when your execution of put option, that means selling through put option, is beneficial, then only your put option will be in the money, right? Otherwise, they will both will be out of the money. This is not exercised. So ultimately, we are getting 5,000 as the cash inflow minus premium 3,500 net gain 1,500. For your noting, I'm just displaying this. Okay, students, hope this is understood.
So in the money means exercised. Out of the money means not exercised.
Yes, that is true. Because in the money will give you the benefit if you exercise through the option. That is where in the money concept comes. Okay, students, let's come to question number 8. Suman wants to buy shares of. Yes, Aminathan. Deeply in the money is also very good because deeply in the money means you will have higher gains. Deep in the money, deep out of the money will be that. Yes. Suman wants to buy shares of EIL, which has a range of rupees 411 to rupees 592 a month later. The present price per share is 421. Her broker informs her that the price of this share can soar up to rupees 522 within a month or so that she should buy a 1 month call of EIL. In order to be prudent in buying the call, the share price should be more than or at least rupees 522, the assurance of which could not be given by her broker. So see the entire story. The broker is influencing Suman to buy a call option at so that the prices will go up and there will be a gain. Though she understands the uncertainty of the market, she wants to know the probability of attaining the share price of rupees 592 so that the buying of a 1 month call of EIL at the execution price of rupees 522 is justified. So, see students, the question is revolving around different values. We need to understand what and what. So, first of all, they have given us a higher and a lower range, which is 592 and 411. At the same time, they are saying that 522 is the price at which the share price can go up to, and at this price, the broker is suggesting to buy a call option. Now, at this price, the call option can be bought, but there is no assurance that the what probability is there to attain this price. Advise her take the risk-free rate to be 3.60 and e raised to the power 0.036 as 1.037 students. So this is using the continuous compounding, right?
Yes.
Higher range 592, lower range 411. This is both happening after 1 month, right? Either it will go up to 592 or it will come down to 411. Spot price is equal to 421. 1 month. Yes, using binomial model, we will calculate the probabilities. Very good. 1 month call option with a strike price of 522, right? Downward, upward, right? There are two possibilities. 411 divided by 421. 592 divided by 421. Probability that the prices would be 592. B, probability of prices going up is equal to e raised to the power rt minus d divided by u minus d. So this is for the first time that we are using e raised to the power rt because this is what it is given in the question. Yes. Now here I am straight away assuming this 3.6 percentage is not a per annum rate. It is just a rate for which we'll have to calculate the present value or using which we will have to calculate the probability in the respective question. Okay. So I'm just straight away assuming this not being at a per annum basis. So e raised to the power 0.036 minus. Now what is the probability of, sorry, the downward proportion of the prices moving down? 411 divided by 421 because the current price is 421 students, right? Yes, very good, Saminathan. Minus 411 divided by 421 divided by 592 divided by 421. This is the proportion of the prices going up, right? And similarly here as well, 411 divided by 421 students. So probability of prices going up is equal to 1.037 minus 0.976 divided by 1.40 minus 0.976. Okay, so this becomes 0.1418. Or can we say 14.18 percentage? Yes. Now the probability that the prices will move to 592 after 1 month is 14.18 percentage. So this will clarify Suman, right? Who was not sure whether the what will be the probability of attaining this prices, right? So now this will clarify that the probability that the prices will move will be this much, and hence 421 will become 592 and 411 minus 522, right? So 522 lies somewhere here. 592 411, the probability here is 14.18%. So the balance probability of prices going down, which is even higher, right, is around 85.82
No.
percentage, which is, yes, sorry.
Sorry.
Okay, so what I'm saying is, which is higher, this, why this probability is higher? Because currently we are sitting at 421. So the chances from 421 to 592, which is a very big jump, is very low compared to a lower price range from 421 to 411 is very high. So the probability here is very high, students. Okay. Clear, students? Any questions or any doubts till now? Let me quickly check the questions. Yeah.
So the price
Okay,
of
there is.
522 is not justified.
So actually, if you ask, yes, because the probability is on the lower side. But the question is only asking us to only calculate the probability so that the buying is justified or not. Okay. So yes, the probability is low and hence the buying at this price is not justified. Okay.
Okay, right.
Yes. So question number 9, students, from again today's assignment. Consider a 2-year call option with a strike price of rupees 50 on a stock, the current price of which is also rupees 50. So this is now, first of all, students, a 2-year call. Okay. And the strike price 50, spot price is also 50. Assume that there are 2 time periods of 1 year, and in each year the stock price can move up or down by equal percentage of 20%. So they are saying it can go up by 20%, that means it can become 1.20, or it can become 0.8, right, if it is 1 in the beginning, right? And there are 2 time periods. Okay, so over a period of 2 years, this is 0 to 1 and 1 to 2. Okay, so over a period of these 2 years, it can happen twice that the prices will move up or prices will move down. With the risk-free rate of interest is 6%, which is also mentioned. Use binomial option model. It is asking you explicitly, calculate the probability of price moving up and down. Also draw a 2-step binomial tree showing prices and payoffs at each node. Okay, so they are asking us to calculate the probability of pricing move up and down, that is step 1. They're also asking us to draw a binomial tree which is showing prices and payoffs at each node. Clear, students? So the requirement is clear?
Yes, sir.
Clear.
Perfect. Now, let's start with, first of all, drawing the tree, binomial tree. While drawing it, we will have to give a name to each and every one. Okay. So let's say this is a node. So 50 is the starting price, right? Because today's price is how much? 60, right? So each node, yes. Now after 1 year, there is a 20% increase that can happen. So 50 can go to 60 rupees. Let's name this node as B, and it can go down to another 20% on 50, so which is actually 40. So 50 minus 20% of 50, which is 10. So 50 minus 10 is equal to 40. And in the B node, 50 plus 20% of 10, which is equal to 60. A, B, and this one will be C, students. Correct? So we have named them the nodes. Now this is the year 1. Okay. Now can anyone tell me how many nodes should be there for year 2?
Sir, year 2 we have 4 notes, sir.
4.
For up we can up and down. For down we can up and down. So total we have
Perfect.
4 notes.
4 nodes, yes. So that is the real essence, that now we will not have to assume again two nodes, right? We will have to again assume for each and every node, again, there is a possibility of price going up or down. So similar thing will be with 60, similar thing will be there with 40. So both B and C will go into two different directions, right? So this B, now 60 plus 20% of 60. What is the 20% of 60? 12. So 60 plus 12,
72. Yes,
72.
72.
Yeah, 60 plus 12, 72, and 60 minus 12, 48. So these are the two upper and lower values, right? So A, B, C we have already given. Let's give this D as 72 rupees. Let's give this as E. Yes, Saminathan, you are correct.
48.
And E, yes, will be 48. Now, similarly, let's talk about this 40. 20% of 40 is 8 rupees. So now this 40 will also result into 40 plus 8 and 40 minus 8. So 40 plus 8 is 48. So can we actually club these two nodes? The answer is yes, we can do that because both of them will give us the same values. So this is E node 48 and then this is F node which is 32 students. Till here the year 2 is ending. Clear? So year 1 and year 2 have resulted into different values. 50 has come for 60 and 40 and 60 has come 70 to 48. Similarly, 40 is 48 and 32 students. So this part is clear. Draw two-step binomial tree showing prices. Till now we are clear. Now payoffs. Okay. Now we'll have to come to the payoffs. Or let's calculate the probability first. Right? Let's calculate the probability first. Because we have been asked to calculate the probability of prices moving up or down. So the probability of prices moving up B PU, right? Probability of prices moving down B PD, correct? So which is given by the formula of PU is equal to, we will be using here 1 plus R, correct? 1 plus R, which is risk-free rate of return. We don't have the continuous compounding here, right? So let's write the formula 1 plus R percentage minus D divided by U minus D. Yes, no continuous compounding as per the question. So we have checked that. So this will become 1 plus 6 percentage, which is R minus D. D is what? 120 divided by 100 we can do, or 60 divided by 50 because the ratio is remaining same, 20%, right? Sorry, D is lower, right? So it will be 0.8 then. 0.80 divided by 1.20 minus 0.80, which is equal to 65%. Okay. So here we can mention U is equal to 1.2 and D is equal to 0.80. So the prices, so the probability of pricing moving up is 65%, and hence the probability of prices moving
35%.
down will be 35%. Yes. Very good. Saminathan, your answer is correct. So this is the probability. Okay, let's write it. Probability of prices moving up by 20% is 65%. Probability of prices moving down by 20% is 35%. Clear? Then calculation of payoffs at each nodes. Calculation of payoffs at each node. Now students, whenever we are supposed to calculate this, always start from the end, right? Always start from this part and then move to this direction. The reason being, A is dependent on B and C. B is dependent on D and E, right? Because they are dependent on what will be the value at their at their subsequent node, right? So always start from this way to this way. Yes, decision tree, decision making as well. We do like this only, Saminathan, right? Then let's calculate the probabilities for the nodes that are there towards the right. So node D, let's take first of all. Let's take the expected price that we have plotted there, the strike price of this option value and remarks that we are having. Okay, perfect. So on the D node, what was the expected price? 72. Strike price is 50. So the value is 22 and it is in the money, students, right? In the money because it's a call option. Spot price is higher than the strike price. E was 48. 50 was the strike price. It is out of the money. Nothing will be executed out of the money. Nothing will be executed. F 32 rupees was the expected price. 50 rupees is the strike price. Expected price is lower than the strike price. It's the
Out of
option of call. Yeah, so it's out of the money. Perfect. Now, let's come to the B node. So the B node will be what we have studied earlier. Since B node is lying on the first year, so it will be the weighted average using probability of these different nodes value taken at a present value, right? That will be the payout at B node. So B will be 22, this one, right, into 65% probability plus 0, which is E node, into 35% probability whole divided by 1.06, students, right? The present value. So the value at B node becomes 13.49, students. Similarly, C node, 0 into 65% plus 0 into 35% divided by 1.06, which is actually 0. Now finally comes the A node, right? So we are going step by step backwards. So A node 13.49 is coming from B node, which is a probability of 65% plus 0 into 35% divided by 1.06. So this 0 is from C, right? So this becomes 8.272, students. So the value of the option is 8.272, and if I quickly want to put it in the tree, it will be, so this was A node, B, C, D, E, F, right? These were the nodes. So the D value was how much? 22. E value was 0. F value was 0. C was also 0. B value was 13.49. And A's value was 8.27. So this is the solution that has been required as per the question number 9. Any
Shall we
doubts,
make the tree?
students?
Yes. Shall we make the tree at the end also, like you made it?
Yeah, it would be good. Yeah, it would be good because then we are showing the different payoffs at different nodes. Or what you can do within this itself, maybe with some other indication, you can mention the different values, right? It's a better presentation. Okay,
Right.
students, sorry.
Okay. I said okay,
Sure.
right.
Okay, perfect. Let's come to some of the MCQs as well, students, towards the end. So the question number 1, while calculating the theoretical minimum price of a forward, return in the form of dividend is dash from the spot price. Is it added,
Subtracted.
multiplied, divided, or subtracted? Yeah.
Subtracted.
Yes, very good. It's subtracted. Chitra, your answer is also correct. People who are responding on chat as well. Yes, you're right. Second question. Dash is used to reduce any substantial gains or losses suffered by organization by taking a position in one market against the existing position in the same or other market.
Hedging.
Yes, it's hedging. So in hedging, we have already have one position. Yes, Chitra, your answer is correct. So we already have one position. Using the second position, we try to offset the risk. In which of the following cases payoffs can be unlimited to the options parties? Payoff can be unlimited. Call seller, call buyer first, call seller, put buyer, both call buyer and put buyer. So this is something which has two viewpoints. Okay, let me put both. See, call buyer is correct, and even to some extent, call buyer and put buyer is also correct. Reason being, see, some of you might say that put buyer will only have a limited opportunity to earn because the prices cannot go down below zero, right? So hence we say that call buyer is the only option that is correct. Okay. So that's all from the today's session, students. Thank you for your patient listening. I now hand over to C. Ashish sir for his concluding and closing remarks. Thank you, everyone.
Thank you.
Ashish sir. Hello, Ashish sir. You are there.
So just coming.
I hope the concepts went well. In case still you have any doubts, you can ask me. We have next session as well. So in the next session, we will be mostly covering the other topics on options, right? Which is, let's say, a put call parity theory, Black-Scholes model, and all those things we will be covering in the next session, students.
Okay, Divas sir, so you have completed the session?
Yes, sir. The session is
Okay,
completed.
okay.
Yes, sir.
Okay, students, thank you for your attending the session and making it interactive. Now, as Divas sir has already displayed our contact number and email ID. So, if you have any query, you are free to ask us. And today you have covered the topic of option valuation.
Yes, sir. Binomial method and
Okay, okay,
questions.
okay. So I hope the student must be clear to option valuation binomial method that have been used.
Yes, sir. That has been
And
covered.
student, very important because this method is important from the two point of view. One we have here discuss where the underlying is the financial instrument, that is stock or index. Then we shall discuss there another version where there will be capital asset. So this will be taken in the last class, this topic. So we will link. So your understanding here, I think you have also covered risk neutral method as well,
Yes, sir. We have covered the risk
because
neutral
risk
method.
neutral method is basis of the binomial model, in my opinion. Because
Yes.
unless and until you determine the probability, it is quite bit difficult for to calculate the value of option. So
Yes. Sir.
thank you, Divas sir, for sparing your
Thank you, sir.
precious time and enlightening the student.
Thank you,
And
sir.
we are very grateful to you because you have done a very lot of research for the same.
Thank you,
Thank you
sir.
very much, sir. Okay,
Thank you.
student. Thank you and have patient listening for the patient listening, and see you in the next class. Thank you and have a nice day.
Thank you.
Sir, thank you
Thank
so much.
you. Thank you, sir.
Okay.
Thank you.
Thank you very much.
Thank you.